let's spend a few minutes talking about sales tax compliance.
Sales tax compliance is generally referred to as the filing of a sales tax return, which means you take either the period in question, a month, a quarter, a year, and you transmit that data to a government. You can do that through their e-portal site. It can be done at either the operating level, the corporation does it, or it can be done at the advisory level, the CPA does it. In either event, there's a deadline-driven task that has to be done to get the tax return to the government in a timely fashion.
And once the return is completed, what comes next?
Well, it depends on who's doing the work. At the operating level, if they're doing the work, generally nothing. They just file the return and move on with their daily life.
Sure.
But if it's an advisory capacity and the accountant's doing it, they're basically required to do a reconciliation. So they perform what's called a recorded versus reported reconciliation. Recorded are the amounts you've recorded in your books and records. Reported are the amounts you've reported to the government. And there's generally some differences between the two for a variety of reasons. It's not really consequential, but there's almost always a difference between what you recorded in your books and what you report to the government. And it's the accountant's responsibility to really put those out, analyze the differences, and report back to the taxpayer on what those differences are.
So speaking of these differences, are they a major problem for taxpayers?
They certainly can be. It depends on the year, but in almost every circumstance, there's a difference between what you record in your own books and what you report to a government. There's several reasons for that. It could be tax rate errors, could be rounding errors, could be more significant errors that you didn't charge tax properly to a customer, or you collected tax and through a clerical error, you didn't remit it to the government. Almost always, it points to an area where there's not an update in your tax technology system, you haven't updated your rates, or some sort of configuration error in your tax technology system. If you're doing it manually, it results from a clerical error. In any event, if the dollar amounts are big enough, then it warrants further investigation because that's what an auditor would do, and oftentimes corrective action will be informed from those reconciliations.
And how can tax technology help with this?
Well, tax technology is good as it's kept up. So obviously we all are familiar with software updates. It's very similar in sales tax technology. The rates change. There's tens of thousands of rates in the United States, and some change every quarter, every month. So if you're not keeping that up to date, then when you're shipping into those areas where the rates have changed, you will be shipping at the wrong rate. So that's a key factor in keeping your tax technology up to speed. Also, the tax law changes on product taxability, new services being taxed, and so you have to periodically review how you've got your product categories and your product libraries taxed or non-taxed in your system for each jurisdiction. That often takes the help of an accountant to do that, but the tax technology, as long as it's kept up to date, should eliminate the majority of errors.